Imagine you're saving up for a shiny new phone, but the price keeps jumping up and down. You wouldn't want to buy it right before a big sale, right? So you might decide to save a little bit of money each week, no matter the price. That way, you'll average out the cost you pay over time. This clever strategy, called dollar cost averaging, which is DCA in short, can be applied to investing too. In this video, we'll break down what DCA is, how it works, and why it might be a good fit for you, all in clear and simple terms. What is dollar cost averaging? Dollar cost averaging is an investment strategy where you invest a fixed amount of money at regular intervals, like every month or quarter. This approach is different from investing a lump sum of money all at once. Think of it like buying groceries. You wouldn't typically wait until you run out of everything before buying groceries again. Instead, you likely go shopping regularly, regardless of whether the price of specific items goes up or down in the meantime. Similarly, with DCA, you're not trying to guess the perfect time to invest a large sum of money. Instead, you're consistently investing smaller amounts over time, aiming to average out the price you pay for your investments. This can be especially helpful when the market is volatile, meaning the prices of investments fluctuate frequently. Now that we understand what dollar cost averaging is, let's explore how it works in action. How does DCA work? Let's use an example. Imagine you have $100 to invest in a specific stock and decide to use DCA. You could split this amount into 4 equal parts of $25 and invest them monthly. Over these 4 months, the price of the stock fluctuates. In the first month, the price is $10 per share, so you can buy 2.5 shares because $25 divided by $10 equals 2.5. In the second month, the price dips to $8 per share. This means you get to buy more shares for your $25, acquiring 3.125 shares because $25 divided by $8 equals 3.125. In the third month, the price jumps to $12 per share. With your $25, you can still purchase 2.83 shares as $25 divided by $12 equals 2.83. In the fourth month, the price rises to $15 per share. You can still invest your remaining $25 and buy 1.667 shares because $25 divided by $15 equals 1.667. By the end of these 4 months, you'll own a total of 9.375 shares. Importantly, the average cost per share you paid is $10.53. This is calculated by dividing the total invested amount, $100, by the total number of acquired shares, 9.375. This average cost per share is lower than the average of the individual monthly prices, which is $10, $8, $12, and $15, which comes closer to $11.25. This shows that if you keep investing small amounts regularly using DCA, you could spread out the cost of your investments over time. This can help, especially when the market goes through ups and downs. Now, let's dive deeper into the 3 benefits of DCA. Benefits of DCA. First, reduces the impact of market volatility. The stock market can be unpredictable, with prices fluctuating often. With DCA, you're not trying to time the market perfectly. By consistently investing smaller amounts, you buy more shares when the price is low and fewer shares when the price is high. This helps average out the cost you pay per share over time, potentially reducing the overall impact of market ups and downs on your long-term investment strategy. Second, fosters long-term thinking. DCA encourages you to focus on your investment goals over time, rather than getting distracted by short-term market fluctuations. By regularly contributing to your investments regardless of market conditions, you're building a solid foundation for your financial future and staying committed to your long-term objectives. Third, enhances peace of mind. DCA provides a sense of security by spreading out your investment purchases over time. This approach reduces the stress of trying to time the market and minimizes the risk of making large investments at inopportune moments. By knowing that you're steadily investing according to a predetermined plan, you can feel more confident and relaxed about your financial future. By investing smaller amounts on a regular basis, DCA helps remove emotions from the equation. You're not making a single large bet on the market at any given time. Instead, you're consistently investing a fixed amount, regardless of what the market is doing in the short term. This approach can help you avoid making rash decisions based on market fluctuations and stay focused on your long-term investment goals. Now, let's talk about things to consider with DCA. While DCA offers several benefits, it's important to understand its limitations and some important considerations before implementing it. 4 things to consider with DCA. First, DCA is not a guaranteed path to riches. The stock market's overall performance still plays a significant role in your investment returns. DCA doesn't guarantee profits, and your investments could still lose value. Second, benefiting DCA takes too long time. DCA benefits those with a long-term investment horizon, ideally 10 years or more. The longer you consistently invest, the greater the chance of averaging out the cost of your investments and potentially benefiting from market fluctuations. Third, DCA may not outperform lump sum investing. While DCA helps average out investment costs, the overall returns might be lower than investing a lump sum at the right time. I know the market is unpredictable, so perfectly timing a lump sum investment is difficult. But lump sum investing with perfectly timing the market has the potential for higher gain than DCA. Fourth, fees can add up. Depending on your chosen investment platform, frequent transactions associated with DCA could incur transaction fees. Be mindful of these fees and choose a platform with low or no transaction fees for DCA investing, especially when dealing with smaller investment amounts. Now, let's check if you're suitable for DCA. Is DCA right for you? While DCA can be beneficial for many investors, it's particularly suitable for the following 3 types of individuals. First, new investors. Starting out in the market can be daunting. DCA helps you ease into investing gradually without worrying about buying at the very peak of the market. You can start with smaller, regular investments and build your portfolio over time. Second, risk-averse investors. If you're comfortable with less risk and the ups and downs of the market make you anxious, DCA can be a great option. By consistently investing smaller amounts over time, you reduce the impact of short-term market volatility on your overall investment. This can provide greater peace of mind and help you stay invested for the long term. Third, individuals with a long-term investment horizon. DCA truly shines when you have a long-term investment goal, such as retirement or a child's education. The longer your investment timeline, the more opportunities you have to average out the cost of your investments and potentially benefit from market fluctuations over time. It's important to note that if you have a large sum of money available to invest and feel comfortable with taking on more risk, a lump sum investment might be an alternative strategy to consider. However, remember that timing the market is incredibly challenging, and attempting to do so often leads to missed opportunities or poor decisions. Ultimately, the best investment approach depends on your individual circumstances, risk tolerance, and financial goals. Conclusion: DCA is a powerful tool for disciplined and long-term investors. It helps you average out costs, reduce the impact of market bumps and dips, and build wealth steadily over time. Remember, there's no single magic formula for investing, but DCA can be a smart and effective way to approach your financial journey. Do you have any questions about DCA? Let me know in the comments below, and don't forget to like and subscribe for more investing tips to help you reach your financial goals.